Paul Manning, BDO Tauranga, you're one of New Zealand's highly regarded liquidators. What are you seeing out there at the moment in terms of business deaths and liquidations and administrations?
So there's definitely been an upturn in the amount of applications to the High Court to put companies into liquidation. So basically there's two ways of liquidating a company in general. One is where the owners of the company, the shareholders, make the decision to say, we're going backwards. Every day we open for business, we have to stop the bleeding. How do we do that? We appoint a liquidator. So that's what's known as a shareholder voluntary liquidation. The other way is for creditors who are unhappy at not being paid, applying to the High Court for a liquidator to be appointed. And there has been a huge upturn in the amount of applications to the High Court to actually liquidate companies. And one of the biggest creditors by far who are chasing money and applying to liquidate companies is the IRD.
So they've had a very hardline approach, the spectrum from very softly kindly during COVID, and now they've almost swung their pendulum the other way. And in fact, it came up in our latest chamber straw poll that it is a concern in terms of stopping growth as IRD's hardline approach. What is the cause of that change, and what is there any tips for addressing IRD issues?
So I would say the change in stance, pretty much the government now is trying to collect tax dollars so that they can run the country. As we know, the economy is struggling overall at the moment. And so if businesses are making less profits, they're paying less income tax. And so if people are paying less income tax, there's less money for the government to collect. And of course, there's all the IRD arrears that has accumulated over the last number of years. So the amount of current IRD debt is below what it has been in prior years. And there's all this legacy debt, including those small business loans that were given out during the, post-COVID or during the COVID period. And IRD are now taking quite a stance in terms of saying, well, it was a loan, not a gift. We'd actually like our loan repaid now. And so there are a lot of applications to liquidate on that basis.
So there's that saying that history doesn't repeat, but it certainly rhymes. What did you see during post-GFC in that period, and how long did that curve take to roll out?
In terms of the IRD chasing, or in terms
just in general
of business recovery? Well, I think the GFC itself was you would hope, a once-in-a-generation event. It was a huge, deep recession. And I think it basically shook most financial markets and countries to the core. I don't think we're anywhere near that stage, and I don't think we will be with this correction or slowdown, if you like. It's a lot shallower recession. There needed to be a correction, in my view. I think post-COVID, there was almost a false economy where people felt trapped in New Zealand or trapped in their homes, couldn't go or didn't feel safe going overseas. What do we do? We'll spend money here. And of course, there was issues with supply of materials, supply of labour. So there was an imbalance between supply and demand. The reality is now the demand has been diminished quite significantly. And so we're just going through what I would say a normal correction of the economic cycle.
So construction makes up quite the biggest contribution towards our GDP in the Western Bay, and obviously GFC had a big focus on real estate and construction and home debt servicing. So in terms of that, had quite a long lag, didn't it? So there were developers that first experienced that liquidation and closures and financial difficulty, but it took quite a while for further down the value chain, subcontractors and others that struggle with cash flow. They still had mouths to feed, but they weren't getting paid because businesses were being closed. So that had quite a long lag effect, didn't it?
It certainly did, and I think what happened was it was all about supply and demand again. And once the demand diminishes and you're a supplier, if you upset your key customer by saying, I'm not doing any more work until I get paid, well, that customer will go to the next supplier. And so there's almost an imbalance, if you like, between the customer and the supplier itself. And that does flow through over time. What often happens when there's a slowdown is that skilled labour, if there's no work here in New Zealand, what are people going to do? They're going to go overseas. And so when demand does actually increase, there's no supply of that labour, particularly at the high end of town, the skilled labour. And so what happens is there's effectively a brain drain. And so what do we do then when the demand increases? Then we have to look to overseas, don't we? Whether it's returning Kiwis or people from overseas trying to attract them to here, to New Zealand. And I think what we've seen in Australia is, people from New Zealand, or people in New Zealand would like to try and attract people from, say, the UK, skilled labour or whatever, but so are Australia. And of course, Australia is a bigger country and it's a larger economy. And so people do comparisons as to how much would I earn in Australia, how much would I earn in New Zealand? And it's not always easy to compete with the big boys like that.
So, given that construction can be quite a boom-bust cycle, these slowdowns should kind of be anticipated for individual business owners. So, what are some common traps that individual businesses, not just construction and a number of fields, what are some common traps that businesses find themselves in trouble when the people start applying to the High Court because they're not getting paid?
So, if you are struggling as a business owner in terms of paying your debts as they fall due, the key would be to get advice, professional advice on a timely basis. And that's like, it's obvious that I should say that because I am a professional advisor who specializes in that field. But often by the time we meet people, it's too late. We needed to have talked to that person 12, 18 months ago, even 9 months ago. And we may have had some levers that we could pull on their behalf to help them get through a difficult cycle. Because by the time, say, the IRD applies to the High Court to liquidate your company, unless you can pay the debt, you're going to be liquidated. At that stage, there's no horse trading, there's no negotiating. We're past the point of rescue at that stage. So the key is to take advice on a timely basis. And it's not, I know when businesses are struggling, money is a consideration. Of course it is. But to have an initial chat with someone, to get someone to point you in the right direction and just steer you over a few speed bumps, it's actually an investment compared to what you could lose if your company is liquidated. Like if you've given your house as cross security, all of a sudden your house is on the line, not just your business. So you should really hope that you can talk to your suppliers before it actually gets to an application to liquidate.
What's the overseas examples, and are Kiwis any different?
I think sometimes Kiwis are very entrepreneurial, which is fantastic, and often can wheel and deal and wind and grind their way out of some sticky situations. But unfortunately, you might be very good at engineering, for example, but that doesn't mean that you're very good at negotiating with your suppliers at a time that, cash flow is an issue. If you engage with professional advisors on a timely basis, and that does include your bank because they're an important stakeholder in your business. So just going to the bank and asking for additional money so you can pay your suppliers, well, the banks want to know, well, how did you get into that? Is it just a blip? Is it bad luck? What is it? And if we do give you more money, are we going to get repaid? So can you justify to us the basis on which we would give you that additional funding? And that would include how and when are we going to get paid that money? So you probably would need to talk to your accountant and possibly your lawyer as well as part of that process.
Obviously, the biggest issue, the biggest red flag is people not paying PAYE, right, on payroll.
Look, PAYE, non-payment of PAYE is actually a criminal offence. So not only can people go after the money, but the IRD can actually prosecute and you can end up in jail for non-payment. And that reason is your employees only receive their net pay after the PAYE deducted. So the PAYE is not yours as a business owner to spend. You're holding it on behalf of the IRD with the expectation that you would pay it out. So it's a breach of trust if you don't pay the PAYE that you've deducted from the employees. So what I often find is that if a bank says no to additional funding, a business owner gets desperate and starts using the IRD as an overdraft facility, and that usually ends in tears because it's often hard enough for businesses during tough economic times to keep current with their IRD obligations. So to keep current and to pay your legacy debt is a big ask. It's not often easy to do.
It accumulates, and from what we're seeing, IRD is sometimes wanting their money regardless of whether that means the death of that business, right?
Well, I think IRD say, well, that's our money and we've asked you for it and we've given you an opportunity to repay it. So, if you're not repaying it, then why should we take a ticket and stand in line? And to be fair, if people can't pay their IRD obligations, are they paying their bank and their landlord and their supplier and their staff? The chances are the hole is getting bigger and bigger. So sometimes it's actually the right answer for a creditor to actually force the position if a business owner isn't willing to, have an honest look in the mirror as to where their business is at and where it's heading.
So employees, they're quite high ranking in terms of the list of creditors in terms of importance. There was a case that was reported in the local newspaper recently where we won't go into specifics of the business, but they prioritised paying all employee entitlements first and then lodging their voluntary application with the company's office. Is that a good thing to do?
Well, every employee goes to work with the expectation of getting paid. And I think that's fair and reasonable. And when we're liquidator, we always one of our highest priorities is to see if we can get the staff paid. So as a business owner, you would have to say that, looking after your staff is the right thing to do. But can I give a comment as to, should one person be paid at the detriment of others? I can't make that call. But I can say that if a company goes into liquidation or receivership, the Companies Act sets out in what priority people get paid, and the staff are one of the highest. So they would be the first to be paid out of the sale of any inventory or the collection of any debtor money. So you would hope that they would at least get partially paid if there was a formal liquidation, etc. But it is not unusual for a business owner to try and do the right thing by his employees.
So is there anything that businesses can do in terms of T's and C's of contractual obligations? So if they are a key supplier to a business and their customer closes, how do they increase their prioritisation in terms of creditors?
So basically, if you are looking to do business with a new customer, for example, that is the ideal time to get yourself sorted in terms of minimising your risk. So the easiest way to minimise your risk is to do cash sales only. But of course, that's not always realistic, right? But for people who supply goods and services on credit, goods particularly, and you see that with the building suppliers, their terms and conditions are quite stringent, often contains a personal guarantee. So if the company does not pay the bills, then the supplier can go after the people who've signed the personal guarantees, usually the directors or owners of the business. So that's one option available. Often they will have a clause in their terms and conditions saying that if the business does go under and those goods have been used to manufacture something else, which is then being sold, well, either they have an interest in the goods that have yet to be sold, or they have an interest in the amounts owing for the goods that have been sold, so that they can trace their product all the way through to the ultimate customer and say, once he pays, we need to get paid. Now, that can be a very, very complex exercise where there's a number of ingredients going in to make a product. And of course, you've got 4 suppliers all fighting for with the same relative priority. So that would be another way. Registering a charge on the PPSR, Personal Property Security Register, would be a very strong way of saying, hey, I'm not an unsecured creditor. I'm actually a secured creditor for these goods over here. But the time to do all this is before you start supplying. So you can't retrospectively put a charge. So you have to do it before you start supplying the goods, or at some stage before the company falls over. So if you've issued goods after you've registered your charge, those are the goods that you'll have a charge or a security over. It's a little bit similar to when a bank gives you a land and mortgage to buy your house. Of course, you can't sell your house without the bank releasing the mortgage, right? It just can't happen. Okay. And it's more technical, but it's a similar concept.
Okay. Oh, that's good. Look, how about we go on to some other common pitfalls, particularly in the governance level. There's a number of business people in business locally that are sitting on boards, whether that's private boards or even not-for-profit boards. I would suggest that the concept's the same, right, for not-for-profits and for-profit entities. If you're on a governance board and you're trading knowing that things are pretty tight or running at a loss and you're probably going to have to close. So what's some common pitfalls for governance?
I would say people sometimes shy away from the conversation, or if they do have a conversation at board level, they often take it offline so that there's no minutes recorded of the conversation, because it's a sensitive topic and people need to be careful what they can say. However, it is really, really important that those in governance, whether it's a trustee or a director, they actually have to front foot and they have to identify and formally minute the fact that there may be an issue, and this is what we're going to do about it. So what are we going to do about it? Well, first thing is you have to understand whether or not you're insolvent. So possibly need to take some advice on that. In general, to be solvent, you need to be able to pay your debts as they fall due. So if you've received goods and services that are payable on the 20th of May, you need to be able to pay it on the 20th of May. And your balance sheet, the assets, the value of the assets must be greater than the value of the liabilities. And so I'll come back to that because a lot of people come unstuck on that. But that's definitely the first thing you need to do. You need to understand what solvency versus insolvency is, and at a point in time. And you also have to have a realistic expectation that you can continue on without creating a bigger hole for New Zealand business society. In other words, your suppliers. So for example, if times get really tough and you say, well, we can see a way forward, but we just need to get through this bottleneck. How can we do that? We need to document how that might be done. Probably take advice, show a cash flow statement or forecast. Excuse me, regarding that. I think that's quite important. And people need to go through milestones and need to measure versus budgeted milestones and be front-footing. So if there is an issue, people address it on a timely basis and talk to their bank as well. I would say that was quite important. Sorry, if I can just go back to the part about balance sheet insolvency. Often when a small business is bought, you might buy inventory at, say, 100,000. You might buy the plant and equipment at, say, 200,000, but you've paid $1 million for the business. So you've only bought tangible assets of the 100 plus the 200, which is 300,000. So you've got goodwill in your balance sheet of 700,000. So that goodwill is what you paid for the opportunity of creating profits in the future. And if otherwise you wouldn't pay it. However, if you've been operating at a loss for a number of years, you need to be realistic as to whether or not that goodwill figure is actually still accurate. And if it isn't and needs to reduce to, say, 200,000, well, then that's a change of 500,000 in your balance sheet. And that can tip you from a solvent position to an insolvent position very, very quickly. And I think a lot of people really struggle with that concept. And then they get a bit of a shock when the bank turns around and said, we're actually a bit concerned about your business. And they will go, but look, we've got assets over here of this amount.
Are there any tips that you can give to new businesses to avoid, as they're starting out, to avoid getting into riskier situations as they progress?
I think the key is to get a team around you. Business mentors, for example. I think you pay $100 or $150 and you may be assigned a mentor, usually an experienced businessman who might be able to talk you through some of that. Getting advice. So talking to your bank to see if they recommend a good accountant or solicitor, to see, make sure you get the structure right. So having 100% debt in your balance sheet is not the right structure. And that's often what we see. We see share capital of $100 and then bank and then of course there's interest on all of that. Interest rates are pretty high. I know they're coming down, but it's still a big obligation to get through each month. I think you need to understand how you can protect yourself, like we talked about with the terms of trade, with registering a charge, all that kind of stuff. And I think you need to be open and honest and talking to people regarding cash flow issues. So Kiwis don't like to be a squeaky wheel, don't like to ring and ask for their money. They find it embarrassing. And it is embarrassing. It is an awkward conversation. But I would be a lot more embarrassed if someone rang me saying, hey, Paul, where's my money? Rather than me ringing you, Matt, and saying, hey, Matt, where's my money? And I do think the squeaky wheel gets the oil. So if you start trading with a customer and you are that squeaky wheel from the outset, you've set the expectation. We've supplied you with goods and services. We did it and we agreed that's what the price would be and that's when you would pay us. Hey, we didn't get payment yesterday. Where is that money?
Easier said than done, because if you're first out in business, you're just stoked to get the customer, let alone you don't tend to have the negotiating power to be able to negotiate terms of trade, especially if you're dealing with a bigger business that might be on 60-day payment terms. You're unsecured lender, you've got a lot of mouths, maybe you've got technicians that are turning up to site or cleaners or whoever it is. They're doing the job, and then you're constantly making sure that the payment's happening even though it's 60 days after. So the business owners essentially has to bridge those payroll.
Absolutely. You got to be able to pay effectively the gross amount of the payroll, which includes the Kiwi saver and everything else. You need to understand what your business model looks like, not just from a profit point of view, but also from a cash flow, because you can't pay people out of profit. You've got to pay them with cash.
Yeah.
And if you cannot, you need a facility in place or a treasure chest in place so that you can actually carry that 60 days.
So would it be wise to make sure that you're looking over your portfolio of customers? You're not just desperate to say yes, and that if there are some customers that you've got on pretty weak payment terms that isn't in your benefit at all, you shouldn't take on more that is potentially a bit risky, and you should be prepared to say no so you lessen your exposure.
Yeah, I think the key is risk management. You're never going to eliminate the risk that somebody falls over, but it is very important that you minimize or manage as best you can. And we often say, even in our portfolios, I could have one client of $1 million, and then a various portfolio to the side of, say, another $1 million made up of 20 other customers. But if I lose $1 million client, my business is a big hole. Would I be better off having 10 customers of 100,000? Probably, from a risk perspective.
Especially if you're an unsecured creditor and they could drop you pretty quickly, and then you have to have tough conversations with your staff, let alone any cash flow situations that you may have.
Exactly.
Yeah. So if a business goes into liquidation or has to close, how often is that perhaps bad luck or bad timing or bad management?
Sometimes it's the perfect storm of everything. I think in a business environment, it's quite competitive, and at the moment, it's challenging times, and of course, there's a bit of uncertainty regarding when and how much we'll bounce back. There's been a lot of changes in technology, changes in labour, changes in software. It's a mixture, all of the above. Certainly in the SME environment, often people needed to put up their hand and ask for advice sooner. And the time to do it is right at the start, because then it just becomes part of the norm. You don't need to pay an independent director 60 grand a year to give you advice, but it might be good to catch up with your advisors every couple of months, or with your banker maybe 3 times a year. Maybe you have an advisory board where you've got 1 or 2 advisors who have no financial interest in your business, but are willing to say, hey, what are we doing here? Where are we at in terms of the financials, in terms of health and safety, in terms of governance, in terms of, legalities and regulations and all that kind of stuff. And that becomes it's not a huge expense, but it adds a lot of value. But the time to do it is right up front, because it just sets the tone for the whole business all the way down. And what it does is it gives a sounding board to a business owner, because it can be a lonely place being a business owner. You see that cartoon of a guy in a high-powered desk, leather chair and everything else, and he's cuddling his teddy bear because he's lonely. He's no one to talk to or to bounce an idea off. I think the key is to have people that you can bounce an idea off.
Absolutely, yeah. And I suppose that's where it's quite important when you're setting up a business that it's clear whether the business you're trading as yourself, as maybe a sole trader versus a limited liability company. Would you encourage most businesses to set up a limited liability company?
Yes, absolutely. Yeah. What you want to do is minimize your risk as a business owner as much as you can. And of course, if you're operating in your own name or in a partnership, it's unlimited liability.
It's the irony. It's never been easier to start a business. $200 in about 5 minutes. You fill in the details, and you're a business owner. But it's never been harder to be in business as well, with a lot of hyper competition, and perhaps the world's changing very rapidly. So, do you have any tips in terms of people that are freshly looking to start their business, and how to at least get through the first 2 years, which is the hardest period, right?
Yeah, I think you need to understand, it is a business. It's not just a labor of love, unless, of course, you're financially wealthy, and in which case it can be a labor of love. But for most of us, we have to go, and it takes a long time to save money. And if we borrow money, it takes a long time to pay it back. So I think the key would be to do a robust, hard-nosed business plan. And that would include some financial analysis as to what the business could realistically do in terms of sales, cost of sales, and what the cash flow effect of those would be for the next 2 years.
So, sorry.
I'm sorry, and I was just going to say, when you start from scratch, it's all well and good saying I'm going to do sales starting at 100,000, then it's going to grow. But to get that first 100,000 of sales isn't always easy. So if it takes you 3 months to get to that level, you're behind the 8 ball on all your other assumptions on your budget and your forecasting. So that's why I say a really hard-nosed budget really needs to be looked at right from the outset.
Oh, and the difference between being a $2 million business to a $10 million business, you ramp up overhead costs really quickly, right?
Absolutely. And what we've seen over the last 12 months for a number of businesses is they've been really good in terms of managing their costs, whether it's labor costs or overheads or whatever else. But the demand for their product has just fallen off a cliff. And it doesn't matter how well you're doing well in terms of cost savings and everything else. If there's no demand for your product, what do you do? If you're tied into, so if you're looking to get from 2 to 10 million, you may need bigger premises. Well, of course, your rent goes up and your landlord expects to be paid, not the old rent, but the new rent, regardless of how much sales you've done over the last 2 years or 2 months or whatever. So with that growth comes often greater risk.
So in terms of putting up collateral, in terms of if you're buying into a business or you're trying to acquire assets with banks, how obviously are they most often looking for guarantees? And most often, especially young people, the guarantee has been the house, home ownership's dropping off. What sort of equity or unique offerings will banks be interested in terms of discussing debt, especially if people don't own a house?
I think the key thing to do would be to have a sound financial model in place which documents that this business is actually viable. And that if you ask for a loan of X amount of dollars, that's all that you need, so that you won't turn around in 3 months' time and saying, actually, I should have asked for twice that. So I think everybody's circumstances are different, and all I can do is give generic advice. But unless people can stress test whether or not this business is financially viable, I think even with security to the side, the banks would be a little bit wary, because they're also under a bit of pressure with responsible lending and all that kind of stuff. And of course, most of the banks are owned by Australian parents who are also, looked at quite closely in that regard as well.
And I suppose the last tip that I've heard from other business owners is that when the time's good, when interest rates are low and you're going well, that's the time to lock in your overdraft agreements if you ever need it, rather than you being your head's in the mouth of the tiger and having to negotiate there. The terms will be far more stringent.
The terms will be far more stringent if indeed you can actually access the additional finance. So if you can negotiate additional finance at a time you don't need it, and you have that as a treasure chest, if you like, or a last gasp, that's obviously the time to have it. And because if you're not in breach of it, the banks are unlikely to take it away from you.
Yeah. Oh, well, thank you very much, Paul, for coming in. Was there anything else that you wanted to share?
No, I think that's pretty much it. I do think from what we're hearing, things will be pretty tight in general in the local economy until probably Q4. Even with Q4, the problem is, of course, people get ready for Christmas, and then Christmas happens, and then January happens again. So if people are just hanging on to Q4, just have a look at what Q1 looks like next year as well, and talk to your bank on a timely basis if you do need potentially additional funding. I mean, there's a lot of green shoots in the Bay as well, with the kiwi fruit doing so well and stuff like that. But there are going to be challenges. We have challenges with the housing and the infrastructure, but we're not unique in that either. But we do have a lot going for us in the Bay, plenty. So, onwards and upwards.
Don't be afraid to talk to advisors and talk to others. Don't be scared. Basically, is that the golden rule from today?
I would say getting professional advice on a timely basis is actually an investment, and it will save you an awful lot of money in the long term.
Great. Thank you very much, Paul, and thank you very much, Toi Ohomai, for letting us use your podcast facilities. Great spot up here in Windermere, and thanks to the students that helped set us up. So thanks, everyone.
Cheers.